AI-driven capex, record-breaking IPOs, and swinging oil prices are colliding with a higher-for-longer interest rate backdrop. And that mix is reshaping the risk and opportunity set across every major asset class. Welcome to vTalkInsight, Allocator's Lens Daily for June 15th, 2026. Let's start with equities, where earnings strength and the AI narrative remain at the center of the story. In equities, the starting point remains strong earnings and solid operating performance, especially in the United States. S&P 500 earnings growth in the first quarter is running around 28%, and despite high price-to-earnings multiples, valuations are described as elevated but still grounded in that earnings base rather than pure speculation. Several allocators highlight that, against this backdrop, U.S. equities look increasingly attractive versus fixed income and cash. They point to productivity gains, margin expansion, and recent upward earnings revisions as reasons why, in a world of structurally higher nominal growth and inflation, staying neutral on equities carries a meaningful opportunity cost unless a clear bearish catalyst emerges. The risk-on tone is not just a U.S. story. Global equities are rallying, with Asia and Europe both posting strong gains as optimism builds around a potential U.S.-Iran agreement and falling energy prices, and breadth is improving, with materials leading S&P sector gains and 10 of 11 sectors in positive territory. Within that broader advance, AI and semiconductors remain at the heart of equity leadership. Semiconductor stocks have surged by double digits in a single session. Earnings revisions for NASDAQ and chip names have been notably positive since March, and a massive AI infrastructure capex cycle, described as even larger than the late 90s build-out, is fueling both near-term earnings growth and an optimistic narrative about future revenue streams. Set against that optimism is a powerful counterforce, a historic wave of equity issuance led by the $75 billion SpaceX IPO and expected listings from other AI heavyweights. The long-running trend of shrinking public equity supply may be reversing as IPOs, secondary offerings, and convertibles ramp up, raising the risk of temporary market indigestion over the next several quarters, even though monthly passive inflows, around $80 billion in the U.S., suggest deep underlying demand. SpaceX has become the emblem of this tension between exuberance and discipline. The deal was heavily oversubscribed. Shares jumped roughly 20% on debut, and near-term index inclusion is likely to force large passive investors to become core holders. Yet the company is trading around 90 to more than 100 times sales with highly concentrated governance, ongoing losses, and significant capex needs, raising obvious questions about valuation risk and index-level concentration. Price action around this issuance wave has already produced sharper swings, with the S&P 500 experiencing both sizable down days and strong rebounds, and implied volatility briefly moving above the low 20s before easing back below 18. Even so, positioning indicators sit near median levels, and sentiment surveys show lingering caution, suggesting that while issuance and AI enthusiasm can inject volatility, the risk of a crowded long unwind may be lower than in past late-cycle episodes. From here, the equity story will hinge on how well this earnings and AI narrative can absorb the coming supply, which brings us naturally to the interest rate backdrop. In rates, the central tension is between a higher-for-longer narrative and the recent bond market relief rally. The Federal Reserve is expected to remove this year's projected rate cut and trim next year's, and some see a credible risk of 3 hikes starting in December that are not yet fully reflected in front-end Treasury pricing. At the same time, term premia in major government bond markets have compressed to low levels just as supply ramps up, particularly through a heavy June issuance calendar. That combination means investors are being paid relatively little extra yield to absorb duration and supply risk, leaving curves vulnerable if inflation stays sticky or if auctions start to struggle. Policy signaling is also becoming noisier. Within the Federal Open Market Committee, divergence of views is increasing and is expected to make volatility more likely regardless of the new chair's communication style. While in Europe, officials continue to flag the possibility of another rate hike, even as markets now price in only one more move and bond yields that have been falling. Recent price action reflects this push and pull. U.S. 30-year yields dropped roughly 8 basis points to just under 5% as safe haven demand faded, and European government bond yields have also moved lower on the back of falling oil prices and easing inflation fears linked to progress in Iran talks. For bond allocators, current yield levels look more compelling than in recent years, but thin-term premia and the possibility of renewed hikes on both sides of the Atlantic limit the margin for error. Key watch points now include incoming inflation data, the tone of Fed and ECB communication, auction performance during this issuance bulge, and UK fiscal headlines around the by-election, which could all shift the balance between carry and capital risk. Those same forces feed directly into how comfortable investors feel taking credit risk. Credit markets continue to clear smoothly, with spreads staying tight and investors broadly comfortable with current yield levels. There is strong demand for large new issues, including from AI infrastructure and technology champions, and fixed income is often described as attractive relative to equities given where policy rates and yields now sit. Large companies are using their scale to tap multiple currencies and structures, building flexible capital stacks that can support aggressive growth plans. SpaceX, for example, is expected to move quickly into the bond market and is seen as a candidate for investment-grade ratings despite high leverage, thanks to substantial equity cushion and recent strategic deals. But this boom in funding for AI and big tech also creates new vulnerabilities. Market concentration in AI-related assets is rising, and correlations between those equities and their corporate credit are increasing, while concerns about circular financing and stretch valuations suggest that a reversal in the AI capex cycle could hit both sides of the balance sheet at once. From an allocator perspective, that means today's tight spreads provide limited protection if earnings for key suppliers roll over, as accounting dynamics can make reported profits very sensitive to order book adjustments. Monitoring primary market reception, rating agency treatment of new AI issuers, and any early signs of spread differentiation between AI and non-AI credit will be crucial as the cycle matures. FX markets offer another lens on how these macro and commodity forces are playing out. In foreign exchange, stress is most visible in energy-importing Asian economies, where past oil shocks have translated quickly into currency pressure. That has forced policymakers to choose between tighter rates, capital controls, or more creative approaches to stabilizing exchange rates without choking off growth. Indonesia has leaned on interest rate hikes to defend its currency, accepting higher domestic funding costs as the price of stability. India, by contrast, has focused on attracting foreign inflows rather than raising rates, a strategy that has been well received domestically and underlines how policy divergence is becoming a bigger driver of relative FX performance. For allocators, this means that the path of oil prices and the outcome of Iran-related negotiations are key inputs to the emerging market FX outlook. A renewed spike in crude, whether from fresh disruptions in the Strait of Hormuz or from energy-hungry AI infrastructure demand, could rapidly retest these currencies and reshape the risk profile of local currency debt and equity exposures. Those same energy dynamics sit at the heart of the commodities story today. Commodities, and oil in particular, remain the swing factor for both inflation and cross-asset correlations. Brent and WTI prices have fallen sharply from peaks above $125 to levels around $80, with recent drops of more than 3% as markets grow more confident about a potential U.S.-Iran deal and an agreement to reopen the Strait of Hormuz. Beneath those headline declines, however, the physical market still looks tight. Crude inventories at Cushing are down to roughly 25 million barrels, well below 5-year averages, and regional product markets are flashing stress, with jet fuel in Northern Europe near $200 per barrel and diesel around $150, highlighting acute shortages. On the supply side, clearing mines from the Strait of Hormuz could take at least 3 months, and restoring full oil and liquefied natural gas flows may require up to 8 months, even if diplomacy goes well. That means any memorandum of understanding or partial reopening could prove fragile, and unresolved issues, such as regional security questions, keep the risk of renewed disruption and price spikes on the table. For now, lower crude prices are feeding a risk on rotation within equities. Energy stocks and European oil majors are underperforming, while airlines, travel and leisure names, and other fuel-intensive cyclicals are rallying as margins improve and lower yields are supporting financials, real estate, and utilities. Cross-asset. The balance between still tight physical conditions and softer headline prices will shape the inflation outlook, central bank tolerance for higher growth, and the relative performance of energy producers versus energy consumers over the coming quarters. Stepping back across assets, the picture today is one of strong earnings and powerful AI-driven growth meeting a higher for longer rate regime, tight credit spreads, and an oil market that looks softer in price but not in underlying tightness. Equities continue to benefit from robust profits and AI optimism. Yet record-breaking IPOs and extreme valuations in flagship names, such as SpaceX, raise questions about concentration, liquidity, and how much future growth is already priced in. Government bonds offer more income than in recent years, but low-term premia, heavy issuance, and unresolved inflation risks mean that carry comes with meaningful policy and volatility exposure, while credit delivers attractive coupons with limited spread cushion if the AI cycle turns. In emerging market FX, energy importers remain sensitive to every twist in oil and policy, and in commodities, the path of Middle East diplomacy and AI-related energy demand will be central in determining whether recent disinflationary relief proves durable. For allocators, the key watch points are clear: the absorption of the coming equity and debt issuance wave, central bank reactions to any renewed inflation pressure, and the durability of oil price declines as physical markets stay tight. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.